My name is Carl Johnson. I'm a certified financial planner for Arrow Advisors right here in Madison, Wisconsin. I'm recording a series of presentations going through some common questions that I get from my resident, fellow, and early practicing physicians. Today we're going to go through mortgage selection. If you have any questions on this presentation or any of the other ones I've done, my contact information is here on this slide, both my phone number and my email. Here's my disclosure. Now let's get started. Mortgage selection. The questions I want to cover today is how much house should somebody buy? What are the pros and cons of different mortgage options? And what mortgage option for first-time home buyers without a lot of cash to put down are available? So the first thing we're going to cover, one of the biggest mistakes I often see in someone's financial life is they simply buy too much home. Once you have too much of a home payment, it can be difficult to afford other financial things that you should have, such as insurances, cash reserves, and being able to invest for retirement. The mortgage industry, and when I say mortgage industry, I'm talking about realtors, bankers, mortgage brokers, will allow you to be approved for up to 40 to 50% debt service off of your total gross income. Now, that would include mortgages, student loans, car loans, credit cards, etc. But you can have 50% of your gross income approved to go to financial debt payments. My general rule of thumb is to not have a mortgage payment exceed 15% of your gross income. Now, the next slide is going to go through how much house can someone get with a 15% gross income payment. Here's an example. If somebody makes $200,000 a year, 15% of that is $2,500 a month. That would be okay with me as a financial advisor for a mortgage payment. This includes principal and interest only, doesn't include taxes or insurance. 4.5% interest on a 30-year fixed mortgage at $2,500 a month would allow for a $500,000 mortgage. If interest rates were a little higher than today they're actually under 4%, but if they're a little higher than 4.5%, even at 6% interest, you can still get a $417,000 mortgage. If you put some money down, it's very possible you could have a $4, $5, $6, $700,000 house with a $400,000 to $500,000 mortgage on it. You can get a very nice house for that kind of money. One thing to note is if your mortgage is over $417,000 by today's standards, they're what's considered a jumbo mortgage. Jumbo mortgages have slightly different rules than traditional conventional mortgages, such as higher interest rates or maybe a more down payment. So there's nothing wrong with a jumbo mortgage, but if you're going to buy a house and the actual mortgage you end up with is more than 417, you might be required to be closer to a 20% down payment, or your interest rate might be a little higher than what you could get if it was 417,000 or under. Once somebody decides how much house to buy, the question I often get is how should I finance it? So I use a 15-year mortgage or a 30-year mortgage. Those are the two most common types of mortgages. There's lots of other mortgages out there such as 10 years, 20 years, interest onlys, adjustable rates. But for the purpose of our conversation today, we're going to compare 15-year mortgages and 30-year mortgages. A 15-year mortgage generally has about a 0.5% lower interest rate. So if a 30-year mortgage is at 4.5%, a 15-year mortgages tend to be about 4%. A 15-year mortgage saves a lot of interest over a 30-year mortgage, and you obviously have your house paid off in half the time after 15 years versus 30. When it comes to a goal versus a method, there's a difference. So somebody may have a goal of having their house paid off as fast as possible or having it paid off in 15 years. If that's your goal, that's great, but it doesn't mean that the best method to do that is having a 15-year mortgage. Just because you take a 30-year mortgage out doesn't mean you can't pay that 30-year mortgage off faster. The next slide is going to go through some numbers comparing a 15-year mortgage to a 30-year mortgage different interest, different payments, and cumulative difference between the interest that you could pay on the two mortgages. For this example, I'm going to use a $400,000 mortgage, 15 years at 5%, which would result in a payment of $3,163, or a $400,000 mortgage at 5.5%, which would result in a monthly payment of $2,271. With the 15-year mortgage, your total cumulative payment is $569,000, which is $169,000 of total interest paid on that $400,000 mortgage over the 15 years. With a 30-year mortgage, you would pay $417,560 of total interest, almost $250,000 more interest. This is where the theory comes from. Why would you have a 30-year mortgage if you can afford a 15? Why wouldn't you make extra payments and save all the interest rate that you could be saving on the mortgage? One thing to think about though is if somebody that's committed to a $3,163,000 mortgage, they would have about $900 less free cash flow than the person with a 30-year mortgage. Here's the summary of that investment account. So I just chose an American Funds investment account. Perhaps people are familiar with it, perhaps people aren't. It's one of the fund families that actually has a 30-year history. So it's not a hypothetical investment account. This would have been if somebody actually invested in that account 30 years ago. It was a full equity account. It's not an asset allocation strategy. It's not what I'm recommending somebody invest in. It's just trying to throw hypothetical options. So the first scenario was somebody investing $892 a month for 360 months. After 30 years, they have slightly over $2 million. The second scenario was somebody investing $3,163 because they paid off their house for the first 15 years and they saved that house payment for the next 180 months. After 30 years, they had $1.1 million saved up. So this goes back to the goal or method. So in scenario one, the house isn't paid off for 30 years, but the mortgage balance after 15 years is only $277,000, and method one had $744,000 in the investment account. If they chose, they could liquidate a portion of that $744,000 and send it off to the mortgage company to pay off the remaining balance on the investment or on the mortgage if they wanted to. Again, this might not be repeatable in the future, but historically speaking, a 30-year mortgage doesn't cost a lot of money. Having a 4 or 5% interest rate is a very low cost money, and a lot of investment accounts over a 30-year time period can do better than a 4 or 5% cost of the mortgage. In this example, the person's $900,000 ahead by having a 30-year mortgage, which is a significant portion of money. Here's different mortgage options. There's 15-year mortgages, 20-year mortgages, 30-year mortgages, ARMs versus fixed. An ARM stands for adjustable rate mortgage. So what an adjustable rate mortgage does is the mortgage rate is not fixed for the entire mortgage period. The mortgage rate can go up usually after a certain term where it's fixed. So that you'll hear such terms as a 5-year ARM. And what a 5-year ARM is the rate is fixed for 5 years. After 5 years, it becomes an adjustable rate mortgage depending upon what mortgage rates are doing. Currently, we're in a very, very low interest rate environment. If you take an adjustable rate mortgage, it's possible in the future the mortgage rate could be lower or higher. It's hard to know what the interest rates are going to be, but I can't really see them going down a lot. The next thing is how much to put down. So the standard rule of thumb for a conventional mortgage is to put 20% down as a down payment and finance the rest of it. If you have less than 20% down, it's almost always resulted in paying what's called PMI, private mortgage insurance. This is insurance that protects the mortgage company if you were to default on the loan. And this can cost one of two ways, is it can cost in a higher interest rate or it can cost a flat amount. So sometimes you'll see a private mortgage plan of 1% of the mortgage balance, and sometimes you don't really see the number because it's built into the rate. So if the going rate on the market's 4%, maybe you get a mortgage that has a 5% rate. There's also programs out there that have special physician financing. These are almost always adjustable rate mortgages, usually require very little money down, and the private mortgage insurance is usually built into the interest rate on the product. There's also such things as like 80-15 loans, or 80-20 loans, or 80-10 loans. 80-20 loans are a little bit harder. So what that is an 80% first mortgage, and then rather than putting 20% down in terms of cash, you can put down 15% down second mortgage on the property, and then have 5% cash put down. The more cash you have to put down, the better rates and terms you generally get on a mortgage. So if you put 80% mortgage down and 20% down cash and carry an 80% mortgage, that's a conventional mortgage and you're going to get your best financing terms for that. But it's also possible that people don't have 20% down and they want to buy a house. There's other ways that you can finance that, and that's the PMI, special physicians financing, or an 80-15 or an 80-10 loan if you only have 5 or 10% to put down. If I was doing a mortgage and I didn't have 20% down, I'd want to see a PMI program, a special physicians financing program, and an 80-15 or 80-10 option to see which one I thought was best.